name is RJ Kelly, and I'm founder and chief visionary officer of Wealth Legacy Group. We're a diversified planning group in San Diego, California, but we got clients in 23 states. And one of the reasons we have clients in 23 states and growing is because of an idea you're going to hear more about today. Not that the concept is new. This has made, for a number of my clients, made them multi-millionaires. But it's something that as a culture, we kind of are in love with this particular area of real estate. We need it for a variety of reasons. In fact, last year when my wife and I, when our house was flooded, we had to go move things into storage for 4.5 months while our house was getting rebuilt. So the question, though, is to whom do you go for this particular niche? Well, especially with the investment market melting down right now in stocks and bonds, the major question I'm sure on many people's minds is where can we go as an alternative to generate income and or capital growth and something that is perhaps a bit more stable and predictable? So that's what we're going to talk about today. And fortunately for me, I have access to a group, pun intended, called Access Capital. Access Capital, like I, does a great deal of due diligence on a number of these different sponsors across the country in different areas of expertise, some oftentimes in real estate, but in other areas as well. And so fortunately, several years ago, I had the great privilege of getting to be introduced to Access Capital and especially one of their senior vice presidents, Sly Puseri. And so I'm going to let Sly drive it from here because he has somebody that we're all going to want to meet. And so, but I'll give a quick shout out to Bill Leitner. Bill, thanks for being with us and just so excited about what you're doing and what you're going to share with us today. So Sly Puseri from Access Capital and Bill Leitner. Bill, great to have you with us.
Thanks, RJ.
Yeah, thank you so much, RJ. I'm Sly Puseri with Access Capital Group. And on behalf of everyone at Access Capital, we are extremely thrilled to have Bill and Lightbox Self-Storage Partners as a partner of ours. It's something, as RJ mentioned, we've seen the development of self-storage really grow into being a core asset class within commercial real estate. So we were thrilled at the opportunity to partner with Lightbox. Bill himself brings 25 years of commercial real estate experience. He started with retail acquisitions and development, helping develop names like Target, Ulta Beauty, Publix Grocery, Dick's Sporting Goods. His firm even received the Grand Slam, which is a perfect 10 on 4 different 500,000 square foot Target developments. They are the only developer to have achieved that feat, and no one's been able to do it since. So again, extremely excited to be partnering with Bill and Lightbox Self-Storage Partners. Their current offering, Lightbox Self-Storage Fund 3, is really a rare opportunity for investors to co-invest alongside some of the most well-known and reputable institutions and insurance firms in the world today. So with that, Bill, welcome, and thank you so much.
Sly, thank you so much for having me. I'm grateful for the opportunity. Thank you, RJ, as well. And I look forward to telling you more about Lightbox Storage Partners today.
I might add that when I have brought this up with clients here in the last few weeks, every one of them has said something to the effect of, oh my gosh, I've been wanting to do that. I'm so glad you're talking to me about this. So I said, well, I'm so glad I'm talking to you about this as well. So with again, Bill, take it away.
Well, thank you. And I think that what's been fortunate about self-storage is that it really has, for lack of a better way to describe it, had a cultural awakening, as we have seen more and more opportunities that are out there in the marketplace. But I think we all recognize that, America coming out of COVID was truly America on the move. And so as such, we saw, I think, more and more people being touched by, self-storage as an asset class. When I used to be in retail, as Sly mentioned, for 20, 25 years or so, self-storage was always the lesser asset class. It's been one that's owned by mom and pop operators. Still to this day, about 65% of the industry is owned by mom and pop operators. And so with that, it never really had that Wall Street or that big institutional emphasis behind it. And so it was just quietly behind the scenes chugging along. But what has really been, I think, an awakening from our side, if you will, the oak inside the acorn, has been that really, if you look at self-storage from a demographic standpoint, and then you filter back from there and you say, can I support what I'm seeing in the demographics and look at it from a financial metric standpoint? Can I take those two together, those two data points, and make a conclusion that we think is undeniable about self-storage as an asset class? And we absolutely believe that's the case. So if you'll bear with me, Sly, what I'd like to do is try to at least play out that investment thesis. So we believe that self-storage is a life event business. The transitions we go through in life trigger a need for self-storage. But at Lightbox Storage Partners, really that theme that is clearly systemic about all of our transitions in life, really in the data point, right, that we can try to determine whether or not we've got an investment thesis that can be supported. So what we did at Lightbox is we wanted to try to understand whether or not this cultural awareness, if you will, in self-storage have put itself in a position where there are more people using it. And the data here tells you exactly that. When we got into the sector 8 or 9 years or so ago, self-storage was about 1 in every 18 people was a renter. If you look at self-storage this year, it's less than 1 in every 10 or so. So without a doubt, we're seeing growing utilization of self-storage, and we think it's driven by really these 4 diamonds that you see up on the screen. And so if you'll stick with me, I'll try to kind of unpack them in a high-level way. They speak a lot to life events, but really urbanization, I think, was the first big push. As PricewaterhouseCoopers indicates, based on their studies, 93 million people moved back downtown. They say that that's probably the most material change in commercial real estate, if you will, since the interstate system was birthed, right? And people started moving out to the suburbs and building enclosed malls. And so now what's happened, a complete retrench. We've all come back downtown. What you're seeing now, though, is it's downtown and then it's town center living. As people are somewhat in these suburbs, or what I'd call close suburbs to the CBD, are now living in these mixed-use environments where you've got office and retail and apartments and all your various services that you need right there on top of you, trying to effectively really become a country in so many ways that lives itself somewhat like European living. The second part that's without a doubt directly related to urbanization, though, is downsizing. I think when we were all growing up, the typical house would always have dining room as well as a living room. And if you look at the designs now, according to the National Association of Home Builders, you have a kitchen and what they call a common area. So what's the really the metric behind that? That the average home size has shrunk now for 3 years in a row. Now flip that one more iteration and say, well, what's going on with apartments? Apartments is seeing the exact same dynamic. When I was doing apartments 20-something years ago, the average 2-bedroom, 2-bath was about 1,200 square feet. Now, if you look at what's going on with the apartment dwellers in these larger markets, like a San Diego, like an Atlanta, like a Dallas, that 1,200 square feet has shrunk down to about 880 square feet. So, right, smaller the house, smaller the apartment, greater the need for storage. Then you flip it, right, and you think, all right, really, what's the other aspect of utilization? And without a doubt, disruption and dislocation, not to be a negative thing, but disruption and dislocation in terms of opportunity is the other thing that drives utilization. And that's America on the move. We saw that in great multitudes coming out of COVID, as we saw these huge migration patterns coming out of New York and Chicago and LA for that matter. But really now we think America on the move is more about the duration to which people are staying in jobs. Most folks are now changing a job about once in every 2.8 years. So as such, this America on the move is without a doubt something that's systemic. And then the last piece is what we saw really coming out of COVID. When we were in COVID, about 5% of our entire workforce across the United States was working from home. Believe it or not, that number's now grown to 15%. You take all those and you put them in the blender. We think the net result is really a situation where utilization is going to continue to grow as these systemic demographic patterns, these systemic demographic drivers are going to stay present. We like to say, Lightbox Storage Partners, demographics drive outcomes. And I think that's exactly what we've got here. But for this group, and for somebody like an RJ Kelly and Sly that's in the investment management business, demographics are hugely important, but really what you want to do is look at analytical data. And you take that data on financial metrics, right? Performance metrics, and you try to stratify and blend it and take it apart every which way you can. And that's what we did at Lightbox Storage Partners to really ascertain whether or not there was something about self-storage above and beyond the demographic aspect. And we believe that self-storage, really the tagline can be number one during the best of times, number one during the worst of times. And the data seems to back that up. So on this slide, we show you 2 points. One is over the 30-year period. Self-storage has outperformed all the major food groups, right? So over the long-term duration, self-storage is at the top of the heap. The part, though, that I think is probably one of the most important metrics in this whole presentation, though, is the one about cycles. And so if you look at any minimum 4-year window from 1994 to 2023, and these are not linear 4-year windows, these are not sequential 4-year windows, these are pick any 4-year window. This can be Clinton, Bush, Obama, Russian ruble, dot-com bust, you name it. Self-storage is one of two, residential being the other, that's in the positive during any 4-year window in which they're operating. Now, that's the top side. But the thing about self-storage that has gotten so much institutional investor excitement and institutional investor interest, without a doubt, is down cycle performance. And the first iteration was in 2008, 2009, during the great financial recession, when everything for the most part was going in the wrong direction. Self-storage rose to the top. So that was the first. And what happened there is you got a lot of that first wave of institutional investor that was trying to come into the space. Again, don't forget, about 65% of the space is mom and pop. So these institutions that come in, they struggle to adequately scale enough product to buy. But the takeaway is that we got W.P. Carey, Crow Holdings, Heitman, some of the best in breed, if you will, opportunity funds, came into the market in 08 and 09. The fund sizes were 250 to 450 million. So on balance, given Wall Street parameters, really pretty small. And that had to do with it all being mom and pop. Now, you take it to today's. And while everybody was talking about Amazon and logistics and industrial, really self-storage during the pandemic quietly jumps to the top again. And this was really what caused the next wave of institutional investor to come. And so coming out of COVID, when self-storage had again proven its down cycle performance, what did we see? Well, really got the attention of the big players. Bill Gates comes in with a $2.3 billion investment. Blackstone comes in with $1 billion investment. KKR comes in with $1 billion investment in the space. So we love the fact that these institutional investors that think about allocating capital properly across a large portfolio of holdings, that they have now all recognized self-storage as a asset class that is recession resilient and has really durable cash flows. Now, the last takeaway, though, is where we sit today. And this was something that we saw coming, we thought 2 years ago. And it's the last remaining huge bucket of capital that's out there that's really not playing in the self-storage arena. And that bucket primarily is pension funds. And so we thought that these Odyssey funds is what they're called. Odyssey funds are primarily these large, lower risk type fund environments that manage pension fund money across the United States. And these are multi-billion dollar pension funds that last forever. Some of them are 30, 40, 50 years old or so. Well, this is the last group that is now seeking an allocation in self-storage. We believe that most of them are going to pick up between a 4% to an 11% in their Odyssey funds. And as such, we have liquidity that's coming into the sector. We have dry powder that seeks to own the sector. And us at Lightbox Storage Partner, as a manufacturer of self-storage, as a builder of self-storage, we are in the perfect position, right, to throw that pitch and let the pension fund be the catcher.
Bill, this all makes sense. I think when you talk about the investment thesis, the fact that self-storage is driven by life events and not so much the market or the economy, and all the different groups that are utilizing it today, it makes sense why you have all of these big institutions making big commitments and investments into the sector.